Okay, we are going to hit on the second objection we hear often, which has to do with the cost to borrow. Meaning when I'm taking a loan to practice the banking concept, that's what I'm interested in a whole life insurance policy for, what's the actual cost to borrow? Like what's the loan interest rate? And the quick answer to that is loan interest rates tend to range between 5 to 6%. That was up until the 7702 change. Beginning 2022, all new policies will typically carry a loan rate that could range on average between 4 to 6%. You'll see the majority between, call it right around 4 to 5%. Some go as low as 3%, but it depends on the loan interest rate environment. So there's a bunch of different rates I spit out, which is all well and good, but the specific question to really lean into it is, what's my policy growing by? So for instance, if we go back to this guy, if I'm earning 5% on everything, because that's why I'm attracted to this policy, if I borrow and have a 6% rate that goes to the insurance company, or even a 5% rate, I'm not that comfortable with it. You know, the advantage to policy loans is that we have control. We don't even have to pay them back if we don't want to. It often makes sense. We do have to if we loan everything out, but my point is we can very easily not pay them back. We pay them back however, whenever we want. You've got complete control. That's the key word, control. But the disadvantage, a lot of real estate investors and business owners have expressed concerns here is, you know, the cost to borrow, say I'm earning, if I look at something conservative, 3.5% to 4%, maybe it doesn't cost me 6% because most policies aren't that high anymore. Say it cost me 5%, like it's a negative spread. I'm not comfortable with it. Well, there's nice workarounds. We're going to look at a workaround at the end of this video, and we're going to look at the negative spread as well, and how and when it could be positive. What we'll look at first is exactly how policy loans work, because that comes up at the same time. How do these policy loans work? How does the insurance company make money? How do I make money? All of this important stuff. Let's take a look, shall we? So we'll begin with a basic example here. 45-year-old individual paying in $50,000 per year. High cash value policy, which highlighted in yellow, represents his break-even point. By year 3, he's paid in $50,000. He has $50,000. This is a high early cash value policy that is well designed. When I say well designed, similar to what we went over in our last video. Death benefit, just over $1 million. Here we go. So that's the growth example, I should say. After 5 years, pays nothing in, lets it sit and grow. The example on your right is the exact same policy. You can see that actually by year 3, years 1 through 3, he's got the identical values. Year 5, he takes out a $200,000 loan. If this is me, my question would be, what is the impact of this policy loan on my money? Because I'm interested in the cash value. Your cash value, think of it this way, is the equity that you have access to, the line of credit, how much you can borrow against. Cash value is that indicator. So we borrow $200,000 out. What happens with the cash value? Drops by about $210,000. The loan interest rate on this example is 5%. What's 5% of $200,000? $10,000. Did we make any payments in the first year? No. We started the next year with the loan interest payments. That's where the extra $10,000, why it was withheld. Now, before we progress on, the insurance company tells me, if this is me, if I'm the policyholder, if you're the policyholder, they tell you, we're still going to pay you dividends and interest on your entire cash value, the $200 you borrowed out and the $50 remaining, as if you never touched it in the first place. So naturally, the response is, hey, that's great. How do you do that? Would you mind telling me? The answer is yes, I'm happy to tell you. If I look at this column, the annual dividend column, you'll see that when you borrow money out, dividends do not adjust at all. On both occasions, we have a second loan down there. But you're continuously earning the same dividend rate, or I should say dividends on everything, as if you never touched the money in the first place. Now that can adjust if I have a non-direct or direct recognition contract, and we've got content on that to get very specific. But the general concept is you'll continue to earn dividends and interest on the outstanding loans. So that's how it's still paid, or that's what still occurs. How the insurance company does that is as follows. When I borrow, I can only borrow cash value, which is what I paid in, and the interest earned over time. They collateralize my death benefit dollar for dollar. Look at your death benefit. I pulled out $200,000. It dropped by $200,000. Also, there's a cost to borrow. Interest cost, in this example, it's 5%, that goes to the insurance company. Just like if I take a loan against my real estate, interest is going to go where? To the bank, to the lender, while I continue to earn the appreciation on my entire property value. I keep compounding, keep going north, which is great. And really, what I want to look at here is all I did was pay back the loan, didn't pay anything extra into it. Cash value, 100% restored, along with the death benefit, to exactly what it would have been as if I never touched it in the first place. $325 and $930. Why the death benefit's lower than it is in year 10 than it was year 1? A lot of people ask that question. Is after year 7 we cut the term rider. It's a nice way to cut expenses and maximize cash value growth. It has to do with that MEC test and that MEC limit. But anyway, this is an example of how policy loans work. Now the cost to borrow. If your cost was 5% in this example, my question would be, am I earning 5% in this? I can whip out a calculator. This is actually an old policy though, so it's not fair. The numbers look better on this one. It's one of the first examples I put together and I like using it in videos, that's why. Let's look at a more recent example here. So here's a policy, $50K for 7 years. Here's what we'll look at. Here's the funding. There's your break-even point. Just about the same. Year 3, you paid at 150, you're at about 148. Now, what we did here, the dividend rate on this policy is 5.65%. A dividend rate is not what we are actually earning on a life insurance policy. Dividend rates are gross rates credited after the company's insurance expenses. This guy, IRR, which represents internal rate of return, net growth. Annual IRR is what I'm earning each year. Think of it this way. If I asked you, hey, what did you earn in the market last year? What did the S&P grow by last year? Oh, 30%. What did it average over the past 30 years? 8%. Annual IRR isolates whatever the actual growth rate is each year. Average IRR factors in the first year, really the negative years, and the average over time. So you'll see the average turn black, where it's in the red for the first 3 years. Once I'm positive, that's where I'm in the black on the average IRR. Annually, I'm earning more than what I'm paying in year 2 with this policy. That's why the annual IRR is positive. So, quick explanation there, cost to borrow. That's the purpose of this video. What I want to look at here is what am I earning on the policy? We ran this conservative here. Tops out at 4.14%. That's at age 50, over 10 years down the road. And the average IRR, can scroll down here, tops out at what? About 3.75%, 3.74 it tops out at. You could say 4% if we look at a different design or product, but still 3.75%. The cost to borrow in this example is what? 4.31%. Based on the annual or average, do we ever hit 4.31% as far as what we're earning compared to what we are loaning against? No. And that bothers a lot of people. It bothers me too. Now, depends on our comfort level. I've had people look at that and say, you know what? I don't really care what the cost to borrow is. I love the control factor, being that I can borrow from this anytime I want, pay it back at my discretion, not pay it back. But some people do look at that and say, wait a minute, as I look at the actual loan interest rate, as I pay it back, like I'm paying more in interest than what I'm actually earning. It doesn't make sense. So as we look at this, what I'm really interested in is, am I earning more than what I'm borrowing against? The answer is no. Now, just like the last example, what you'll find is when I pay it back, so here we took the $300,000 out, death benefit, I kind of minimized the screen, but same thing happened, was collateralized dollar for dollar. And really when it's paid back in this example, so I've got year 20, IRR 4.05%, $618,000 in both examples. So cash values are completely restored to what they would have been as if I never touched it in the first place. So if that doesn't work for someone, that cost to borrow being too high, there are alternatives. We have what's called a cash value collateral loan, which we don't offer or write at our company by any means. These are through a lender or bank. What it involves, it's very similar to real estate in the sense that I take a policy with cash value in it, and I say, hey bank, I've got this policy with cash value. I'd like to assign a percentage of it to you, or all of it, as collateral. They will then give you a loan, very similar to a line of credit. The underwriting is minimal on these. Typically, I don't have to provide extensive financials, tax returns, none of that stuff. Minimal underwriting, but much more attractive rate. This, in the present interest rate environment we're in right now, makes sense. Years ago, it didn't always make sense. But again, it's being aware of the options that exist, especially with the cost to borrow, that are powerful. Because what a lot of people look at here, they say, hey, I love this concept. I love the fact that I can get money into a policy and it's probably going to produce somewhere between that 3 to 5% internal rate of return. This is tax-free too if I don't mech it out. Going back to our policy design video, but the cost to borrow is just not slicing it for me because I do intend on purposing this money for real estate, or I'm going to want to access it. Well, here's a nice alternative. Same loan, 3% with a cash value collateral loan, which is very common to find with lenders right now based on the interest rate environment. So with the cost to borrow, it's good just to have awareness, transparency around it. What's the actual net cost and does it make sense? Does it help me? Does it hurt me? All that good stuff. So I hope you enjoyed this one. Please reach out if you have any questions. We'd love to connect with you. And please hit the like button, subscribe. I hope this helps. I'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.